Welcome back to our earnings special, Quarter Se Quarter Tak. We're previewing sectors and getting you insightful opinion from our three guests, Nishal Maheshwari, Gautam Dugard and Sanjeev Bhasin. Gentlemen, thanks very much for staying with us. So we got through a couple of sectors in the last segment, IT and banks. Let's take a look at what we can expect from the bellwether FMCG sector this quarter. Mangalam Malu, who tracks the space, is standing by with a quick snapshot preview. Mangalam, over to you.
Well, for FMCG, it's a quarter of sustained, or rather hope of sustained recovery, though analysis would be a little difficult given the jarred nature of this quarter. 1 quarter after demonetization, 1 quarter before GST was a base quarter, 4th quarter FY17. But by and large, the sector is likely to see mid to single-digit volume growth. Watch out for improved offtake after November because of the additional cuts seen post-GST revision. And margins may expand for the food companies, benign food costs. However, they may be contained for the home and personal care companies given higher crude and crude derivative prices. For HUL, Dabur, Imami, Bajaj Corp, volume growth between 5 to 8% is expected. Britannia likely to outperform with a gain of almost 9 to 10% on the volume front. But remember, all of this will also be viewed with the management's commentary and the sector valuations, which are at record highs.
All right, stay on Mangalam. Let me invite Nimesh to tell us what to expect from the auto sector.
For auto and auto components, expect Q4 to be a very strong quarter, aided by low base because of the demand effect same quarter last year. In fact, the street is penciling in 22% PAT growth, and if you remove Tata Motors, then the PAT growth is expected to be 28%, which will be the highest in the last 8 quarters. In fact, Tata Motors and Maruti will roughly contribute close to 52% of the total profit pool in Q4. In terms of things to watch out for the demand outlook in FY19. Watch out for margin pressures because of commodity price hike, and watch out for the new product launches pipeline. In terms of auto components, Street is expecting a very strong quarter for companies like Motherson Sumi, Apollo Tyres and Bharat Forge.
Nimish, thanks very much. Anisha is now standing by with a quick check of what to expect from the capital goods and roads sector. Anisha.
Well, Q4 is seasonally strong for industrials and road players, and that should play out this quarter. We are looking at a 15 to 20% top line growth. Order inflow has been strong when it comes to the road players as well as T&D players, but not too strong for defense and oil and gas and other allied sectors. In terms of the companies, for L&T, we are looking at a top line growth of around 10%. Order inflow should not be a worry given Q3 was strong, and Q4 has also seen a systematic inflow as far as order inflows is concerned. For Adani Ports, we are looking at a port volume growth of around 5%. Tepid because coal volumes have been a bit muted given there was not much coal imported from Mundra power plant. However, container is expected to remain steady. Bottom line, of course, the growth will be limited because the company has now a higher tax incidence. Similar is the case with Dilip Bilkon. Now, while the top line growth is expected to be very strong at 20 to 30%, higher tax incidence is expected to limit the bottom line. Other than that, the order inflows have been strong and the company has been beating its revenue guidance as well as the order inflow guidance, and that is expected to pan out this time as well. Back to you.
All right. Well, we have to be quick. Gautam, anything in the infra space that you like? I mean, capital goods and roads?
Yeah, clearly we've just come out with a big thematic report outlining our thesis of industrial capex recovery. We like Thermax over there, best play on industrial capex recovery. L&T continues to find mention in our model portfolio, and as your correspondent was mentioning, roads companies are having a dream run actually in terms of order book, in terms of execution, in terms of the strength of execution that they are doing. So I think roads remains very strong, just that the stocks have run up. So that basically is our view.
Nishal, I mean, your sense briefly on this space, the infrastructure space?
So we have been very positive on this space and we continue to remain very, very positive given that the order books have been record. Actually, we look at in the last quarter and the kind of orders which have come out from NHAI is at record. More than 50,000 crores of orders were actually given out. Again, in the next quarter, another 50 to 80,000 crores worth of orders are pending basically, which will be given out again in the coming quarter. So I think road companies are doing extremely well. But this is not road alone, basically. If you look at Larsen Toubro or other companies, I think they are getting orders from everywhere. But largely this capex has been driven by the government.
Okay.
And we continue to believe that the earnings as well as the order books are going to be very strong for these companies at least for the next 2 to 3 years.
Okay. Okay. Well, FMCG, Sanjeev, you know, any company I touch is like, 45 times, etc. I mean, I'm of course going trailing. Do you think even if the numbers come good, as Mangalam says they will, they're worth buying?
Well, that's why for us the top pick for this year would be ITC. It trades at 27, 28 times, and you're not factoring in the positivity on a host of other businesses aside from FMCG and cigarettes. You're talking of hotel, you're talking of paper, you're talking of Will's Lifestyle, the apparel, and you're talking of the milk and the other, ITC Haryali. So I think ITC is a no-brainer. I could surprise all the pundits on the upside. HUL, like you said, will be expensive, but on the personal care, that seems to be one of the best plays. And thirdly would be Dabur. But Lata, the real icing here would be on on the consumer beverages side, where Nestle, Tata Global, and Jubilant could actually outperform on the upside.
Oh, that's a tasty idea.
Oh, okay, let's go to autos now. And I think Gautam earlier mentioned briefly that they're going to have a blockbuster quarter. Gautam, volume growth has been pretty strong. Margins, you think, would keep pace?
Yes, I think volume growth has been strong across the board. Two-wheeler, three-wheeler, and of course CV cycle has been on a tear. So that plus the mix improvement also, coupled with the operating leverage, should ensure that there should be a YOY margin expansion. In fact, for our universe, excluding JLR, we are expecting a margin expansion upwards of 60-70 basis points on a YOY basis. But clearly, I mean, if somebody wants to play a consumption recovery theme and is scared of FMCG valuation multiples, then I think auto is a better way of playing the same theme. You get more bang for buck here, also on the rural side, where things like M&M, Maruti, those things can continue to do very well. We are expecting very strong performance from M&M, Maruti. We're expecting strong performance even from Hero for this quarter. So auto, I think, will have one of the strongest quarters in this season.
Okay. Quickly, Nischal, across FMCG and auto, what or who will you watch?
So I think FMCG, our top pick, continues to remain as lever basically, and it's a good play on the expected good monsoons. So it's a good rural play, and we continue to like that stock. In case of autos, we have been very positive on the CV cycle, and our top pick out there is Ashok Leyland. I think after the first 2 months of disappointing numbers, I think the last month number was very, very strong for the CV sales. And given the strong outlook and the growth on the IP side, I believe that is a stock one should be having in its portfolio.
Well, on that positive note, gentlemen, thank you very much for joining us. And that concludes the first part of our curtain raiser to the upcoming results season.